Hi and welcome to Westpac London's end of day for Monday, August the 1st. What a day too. It started off optimistically with the news over the weekend that the politicians in the US had managed to cobble together a bit of a deal, which basically means that the debt ceiling for the US government will be lifted later this week. That means that there's no risk of short-term default of the US economy. The deal itself was pretty pathetic, really. It only extends the ceiling until February of next year. Substantial further cuts have to be agreed by November for the ceiling to be extended right out to 2013. If further cuts aren't agreed by November, the automatic sequester cuts in. And by that I mean various unpalatable cuts for both political parties will automatically take place. That's almost like the stick that's designed to encourage these guys to actually make sure they come to some further mutual agreement. The bigger issue though is that the underlying assumptions that are used to determine how much debt is going to grow over the next decade, for example, are woefully optimistic. As we saw last week, very weak economic growth numbers were released for the US. That should serve to remind everyone that the horrific debt acceleration in the US that everyone's worried about is actually going to be a hell of a lot worse, given that they won't actually achieve the sort of growth numbers 3% plus that are factored into those forecasts. The reality is we think the US economy will struggle to get 2% growth over the next few years, which means the revenues won't be as much as anticipated, which will further put upward pressure on debt. Anyway, for the initial response to that was positive. We saw stock markets up very sharply in Europe. The German market up, for example, more than 1.5% at the open. But boy, has it turned pear-shaped since then. To give you a feel, still focusing on Germany, the German market has fallen from its peak today to where it's standing at the moment by 4.5%. That means the DAX is actually down 2.5% from its close on Friday. So initial surging optimism. The detail actually doesn't look that good, but then on top of that, we had the release in the US of a weak manufacturing survey from the ISM, Institute of Supply Managers. It fell to 50.9. That's its lowest reading since the recession of 2009. And it followed a weak UK manufacturing survey, which actually dipped into negative territory, i.e. with a sub 50 reading of 49.1, suggesting that UK manufacturing is actually going into recession already. So the weak economic numbers plus a realisation that the debt ceiling deal really wasn't a particularly good one has really hit equity markets hard. Just to give you some numbers, the Dow as it stands, it was up at the open. The Dow is currently down 0.83%, and the average loss on European markets is around 2.6% today compared to the close last week. Following on from that, other markets have seen pretty volatile moves as well. US 10-year Treasury yields from a high today of 2.85% and now down to 2.72%. That's a 0.13% drop in that yield, which is quite a significant move, and that's on the weaker economic data. Gold prices are pretty much flat today, $1,632 an ounce. Oil's down around 0.5%, $95.16 a barrel. Copper's down around 1.3% today. Aussie dollar's weaker too. It fell from 1.106 to 1.094, mostly after that weak factory survey out of the US was released. What have we got to look forward to? Well, we've got the Reserve Bank board meeting coming up Tuesday your time, and figures on house prices and building approvals. We don't think the Reserve Bank will lift interest rates. There was a bit of an inflation upside surprise last week, but the detail should give Reserve Bank comfort that that's not the beginning of a new trend. And the underlying story in the Aussie economy remains pretty weak. Okay, that's it from me today. I'll speak to you again tomorrow.